Hello and welcome to our discussion on financial statement analysis. In this session, we will understand and recap the DuPont analysis. The DuPont analysis shows the drivers of return on investment. In this case, we will try to see the drivers of return on equity. The DuPont analysis will help us in understanding the ways to manage the return on equity or any other form of return on investment. In order to do that, the DuPont analysis decomposes the return on equity into the operating decisions, financing decisions, and investment decisions related issues. So let us calculate the return on equity from the balance sheet and the income statement information. So in this case, the return on equity is equal to 22% PAT by equity. But in order to understand the drivers of the return on equity, we have to segregate or decompose the ROE using the DuPont framework. According to the DuPont framework, the return on equity can be divided into PAT by sales, sales by total asset, and total assets by equity. PAT by sales reflects the operating decisions. Sales by TA is a reflection of investment decision. How best are we using our assets, and that is measured by comparing the turnover with the assets. And the financing decision is reflected by total assets by equity. So in this case, PAT by sales is 22%, sales by TA is 0.7, and TA by equity is 1.42, and PAT by sales into sales by TA into TA by equity will be 22%. But to understand the drivers better, each of these ratio can be further drilled down. For example, the PAT by sales can be further drilled down into the tax burden, which is PAT by PBT, the interest burden, which is PBT by PBIT, and the operating expenses burden, which is PBIT by sales. So in order to manage the PAT by sales, the management has to manage the tax burden or interest burden or operating expenses burden to increase PAT by sales. If any of these burdens are reduced, the PAT by sales will increase, which will increase the PAT by equity or ROE. And similarly, the sales by total asset can be further drilled down on the basis of the non-current assets and current assets. So sales by non-current assets and sales by current assets. In order to make these steps a bit more meaningful, we can go one step down further and take this analysis further down. For example, the operating burden can be examined in detail by examining the expenses to sales ratio. In this example, we have two main expenses, that is OPEX, depreciation, and COGS. So therefore, OPEX by sales is 33%, depreciation by sales is 8%, and COGS by sales is 25%. So it's possible to increase PBIT by sales by reducing any one of them. But to reduce, it is necessary to examine and compare the performance of a particular company with its past or the competitor to understand whether the company is in line or the efficiency or effectiveness of using the financial resources optimally or not. In the same way, the current asset can be further drilled down, whether sales by cash or sales by debtor, and this is a popular debtor turnover ratio. So we can see that by examining in order to understand the drivers of return on equity, we calculated several ratios which have a direct or indirect effect on return on equity. So in order to understand the return on equity or the profitability, it is not enough to just calculate the ROE, but it is also necessary to understand the drivers of ROE which the DuPont analysis provides. However, one has to be careful with any return on equity based evaluation because the return on equity is from the financial statements, and the financial statements are based on GAAP, generally accepted accounting principles, and there are several gaps in GAAP in the form of flexibility in the measurement. So there is a possibility that the items can be measured and managed to increase the PAT by equity. So DuPont analysis is not therefore the end by itself, the means to end in the process. We try to understand the impact of all these ratios on the return on equity. Here we calculated about 10 to 15 ratios, but depending on the complexity and comprehensiveness of the financial statements, we can have several more ratios to strengthen the interpretation of return on equity, and that is called the DuPont framework. Thank you very much.